The kids are finally back to school, fall is in the air, and I'm back for week 4 of our general knowledge mortgage renewal series. I thought I was done, but I've been having a lot of good conversations with people, and something came up that I thought you all might be interested in, so I wanted to shoot another video. Now, before I get into that, I want to stress the purpose of this video series. I believe that knowledge is power. I believe you should educate yourself when it comes to mortgages, but that's not so that you can make mortgage decisions all on your own. It's so that you have the knowledge to ask the right questions and have a meaningful conversation with your advisor. Now, you probably have an advisor when it comes to your investment account, so it only makes sense that you should get advice when you're dealing with what is probably your largest debt, your mortgage loan. And this week I had an interesting call with somebody that, they got some information from a lender and they wanted to, bounce it off me, see if I could shed some light on it because they were a little bit confused. Now, this is the call that I got from somebody. They had saved really, really hard to accumulate a down payment of 20%. So, for example, if they were buying $1 million home, they managed to save up a whopping $200,000 and will need an $800,000 mortgage. Now, at the same time, a friend of theirs is buying a home. Now, they aren't putting 20% down. They're only putting 10% down. But for some reason, they're getting a better rate from the lender. They're getting a better interest rate despite putting less money down. And that confused, the individual that I was talking with. So, in Canada, we've got 2 basic types of mortgages. We have conventional mortgages. Now, this is where the individual has put 20% or more down. And because there's some equity in the property, a little bit less risk for the lender, the borrower is not required to get mortgage default insurance. They certainly can, but they're not required to. And then we have what we call high ratio mortgages. Now, these are mortgages where the buyer is putting less than 20% down, so there's more risk for the lender, and as a result, they're required to get mortgage default insurance. Now, this insurance is paid by the borrower. It can be paid in cash, or it can, often be added to the mortgage amount, but the coverage protects the lender. In the event of default, of course, the lender is going to have to go through the appropriate legal channels, perhaps a power of sale, perhaps even suing the borrower. But at the end of the day, if the lender is out of pocket, this insurance protects the lender. So as a result, these high ratio mortgages, these higher risk mortgages, once they're insured, they're actually safer from the lender's perspective as compared to a conventional mortgage where the borrower put much more money down. Now, the insurance premium is not cheap. I'm on CMHC's website. They are one of the main insurers. And for example, the premiums are not cheap. They're based on the loan to value, or LTV ratio, which is the value of the mortgage in relationship to the value of the home. So if you're putting 10% down, which means an LTV, a loan to value of 90%, as of right now, the premium sits at 3.10%. And that's based on the borrowed amount, and it's a lump sum premium. Now, there is an upside to this. Because the mortgage is insured, and that means it's safer for the lender will actually give an insured mortgage a better interest rate. And CMHC even says this on their website. I'm going to read it to you. It says, remember, without mortgage insurance, you may avoid the insurance premium, but you'll typically pay much higher interest rates. In other words, if it's an insured mortgage, you'll pay lower interest rates. Now, here's where it gets really interesting. I went online and I looked at CMHC's master policy. Now, the coverage is for the entire amortization period, not just the first term. So what does this have to do with renewing your mortgage? Well, if you just look at the numbers, or even if the lender just looks at the numbers, it may no longer look like a high ratio mortgage. Maybe the property value's gone up and the mortgage balance has gone down. So it might not look like a high ratio mortgage, but if it was originally CMHC insured, it is still CMHC insured. So when you're renewing your mortgage, it makes a lot of sense for you to remind the lender, hey, don't forget, this is a CMHC insured mortgage, and as a result, can you get me a better rate? Or if you're moving the mortgage from one lender to another lender, but again, it's the same mortgage, it's still CMHC insured, advise that lender that, hey, this is a CMHC insured mortgage. Now, if you're a lender, a mortgage agent, or broker, I'd love to hear your thoughts on this. By all means, please comment in the comments section. Again, the purpose of this series, as I've been stressing throughout it, is not to replace those advisors. It's to give borrowers some information, some food for thought. Maybe they can do some pre-work before they have those conversations with those professionals when they're renewing their mortgage. Well, that's it for me. I am done with this series, and I'm moving back to working with our exam prep students. But if anything interesting comes up, I'll be sure to shoot another general knowledge video. Have a great day, everybody.